Hey, Think Realty Nation, Eddie Wilson here, and I know I do not look like Avi Golhar. Today I'm going to do my best impersonation of our host of the podcast. And actually we're going to do something special today. We're going to do a little bit of a co-hosted show. And so I want to welcome you to the show. We've got an awesome guest today, but I'm going to turn it over to Avi.
Hey guys, we've got an awesome podcast sponsor. Before we get into the show, this podcast is brought to you by Housefolio, sourcing, analysis, transaction management, rehab, budget tracking, asset management, and disposition, all in one software for single-family real estate. Grow and manage your whole single-family investment portfolio from one simple-to-use software. Check them out. Go to www.housefolios.com to get started. I'm excited for the show. We've got my good friend and one of the premier lenders in the country in the house today, Streamline Funding, Romney Navarro. Welcome to the show, man.
Thank you, sir.
You get two for the price of one. Look at that.
I wasn't expecting this.
I mean, me neither. But
or
good.
This.
What did you show up for?
I don't know. For the coffee, I guess.
That sounds about right. Well, we have a lot of questions in store for you. So, Eddie.
You want to jump in? Do I get the first honors?
You get the first question.
Very
Inaugural
cool.
question.
So Romney, obviously, I think what's on the mind of every real estate investor, think Realty, viewer out there, is where are interest rates going? I mean, it seems like it's an undulating marketplace today. Everything is moving. You guys are at the forefront of it. So where are we at? Where's this thing going? Like, how do we play in this as real estate investors?
Man. Loaded question in some ways because it's always a guess, but we all know they're moving upwards. Interest rates are going up. As a lender, as a private lender at that, I think it's opportunistic for us in many ways because as those rates go, ours rates stay. Mm-hmm. So I believe it's kind of bittersweet in the industry. Bitter for those who are getting accustomed to the rates. I'm certainly getting accustomed to the rates on some of our conventional stuff, but sweet for those that are providing some higher interest rate product. So it's just a little bit of a settling in the marketplace. Again, might be a little bit clouded, a little bit biased because ultimately I get to benefit from this. Mm-hmm. I'm not going to be increasing my rates as a result of conventional loans increasing. So I think we're in a pretty good place as a whole. Real estate investors generally should understand that the money is still available as a result.
One quick follow-up, and I'll turn it over to Avi for whatever question he has. But so with that being said, is this right now the prime time to go borrow private capital? I mean, are rates ever going to be as low as they are right now if it's moving upward? Like, should I be on the fast track of leveraging whatever I have to use the capital that's available today to go out and get it?
So it's funny. It almost sounds like I was lying on my first response. But yeah.
Are you changing your story?
Next. No, I mean, at the end, let's just say this. They've never been this low in our space.
Yeah.
Today I write a new construction loan as low as like 7.9% interest only over about 18 months. When we first met, I was writing that same loan at about 14.5%. Mm-hmm. So I've been pressed. I don't have intentions of moving up because this was once part of the master plan.
Sure.
It was basically we're going to get to a point where we're going to be able to lower our rates, still sustain, and just pass the competition by. So I think what we're trying to do is stay there. That said, I think the broader markets are going to continue to increase. Mm-hmm. So yes, the time is now. From a strictly capital or financial perspective, the time is now.
Got it.
So one of the things that you need to pay attention to if you're listening and you're watching is, hey, money's available, it's not going anywhere, and go get your capital so you can do your new construction deals. You primarily lend in Texas.
Mm-hmm.
You're in Austin, you're in Dallas, Fort Worth, you're in Houston. You love Texas. I actually looked at the business district for the energy corridor where we are today in Houston, and does it look like a semi-automatic to you? Like it looks like. Have you seen it?
Like the aerial?
Yeah, have
like
you
a
seen
gun?
it?
Like is this what we're talking about? No.
Yes, no, exactly.
Yeah, I got nothing.
And that's just okay. Well, it does, and it just kind of reminds me of like, go do it now. Like, it's a smoking gun. Right now, you have opportunities to go borrow money. Are you seeing more activity in the new construction space for you? Are you seeing more fix and flip deals? Are you seeing more single family rentals that you're doing? What's the secret sauce for borrowers if you have any recommendations?
Man, that's another one of those loaded questions. It's like pick your poison, right? So what do you do? We've talked about some investments on short-term rentals. It's a personal goal of mine to have a handful of short-term rentals in resort communities. It's not what I do. I'm a lender, but I can dabble in that. Dabbling's not, what's on the menu in investing, especially when we're talking the amount of dollars that we're talking about. So my clients are best served when I give them a construction loan. My clients are best served when I give them a construction loan that turns into a rental property. That's like the ideal thing. The industry as a whole seems to have been trending towards rental. Seems like there's a lot more money that's entered that space, therefore a lot more, supply. But I do think new construction is an opportunity that's still prime. A perfect example of that, we're about to close one of the biggest deals of my career. Can't wait to talk to you about that offline. It's about $22 million, about 290 units in San Antonio. The equity sponsor is bringing something to the tune of about $5.5 million to the table, $6 million. And that deal takes a minute. You don't just text somebody the terms and you close. That takes a minute to get there, including even getting that equity. And this guy has a portfolio of about $300 million worth of multifamily real estate. And he says, I buy Class A real estate. I said, okay, great. And I looked at his portfolio. Everything was built in 2011, 12, 13, 14, roughly. He's like, I can't buy anymore, so now I build. So I think there's opportunity in building because of the cost, the savings. Okay, the market is high. Good, bad, or otherwise, it's high. So if he was going to debt service buying off the shelf at 1.25 or debt service at 1.9 building himself, I think he'd rather go with the latter. So there's a lot of opportunity in new construction because of the savings, the built-in equity that you get from it. And I think we could all kind of attest to that. Like you build and you got built-in equity day one.
Yeah. How are you advising your clients, those that have been around for a while, pros in the space, that are wondering how to still manage the cost of labor, manage the cost of supplies? Is that starting to unlock a little more for them now? Are prices starting to decrease?
Mm-hmm. They are.
I mean, we've seen crazy inflation over the last couple of months, and I don't expect inflation to really decrease at least until early next year. How do you recommend that these borrowers that are doing new construction deals, as an example, they kind of rein in those costs as much as they can?
So this might be a little bit of an unconventional answer, but I look to them to tell me. These guys are the ones on the ground. I don't build. They do. They do it 100 times a year. I do it 0 times a year. I manage the finances for a lot of those projects, all of those projects, but they tell me. So I listen to the market and I share best practices. The general rule of thumb this year has been, all materials went up, all labor went up. Material hit this like white hot period where it was almost to the point where you couldn't build. Now that savings that I was telling you, that built-in equity was almost gone. That subsided a little bit. It's kind of leveled off a little bit, but I do think inflation's obviously playing a role there. So it's, you're kind of damned if you do, damned if you don't, or at least it's kind of getting pushed back up a little bit just because everything's a little bit more expensive. But the crazy costs that we had in early 2021, mid 2021, those things have burnt off. You can build a house for a reasonable price again.
Okay. Yeah. Can I jump in?
Yeah.
So, smoking gun questions. Obvi references firearms. I'm not really sure where we're going with all this. Let's go ahead and go.
I had an idea.
I hope you guys could pop one in there.
Let's go. One more loaded question. All right. So the viewer, if I'm sitting there and I'm a Think Realty, viewer, and I am going and I'm navigating all of this, what I really want to know from a lender that rarely is spoken about, they never give the answer. I'm going to see if you're willing to give it. Okay, is how do I get the cheapest capital? How do I convince you, the lender, that I'm worthy of getting the lowest rate that you're willing to give, right? Because we kind of know this game. It's like this game is like, if you're brand new, we might start a little higher, and then if you do a lot of more deals with us, then we'll work you in. Like, how do I come in if I'm playing in the Texas space and I want as cheap capital as possible? Tell me how to get it.
Okay, so great question, and it's the one that people ask but maybe don't know how to ask. I think they ask with the intention that the answer that because they asked, they should receive.
Sure.
And funny little pre-segue, on Friday at this conference, I'm giving a presentation. I'll spare the title because it's a little off color, but how to be bankable is the shorthand version.
Yeah. Does it start with an F word?
There's an F somewhere in there.
But it really means funding.
Yeah.
Okay. All right.
Bankable.
I think
AF.
Okay.
Something like that.
Fun's good.
That's fine.
Fun's a good word.
But you know what? The thing is, anybody can obtain financing for a project. That doesn't mean you have a 100% chance of it.
Right.
But anybody can. The question is, how do you get the best pricing? So what I'm going to talk about on Friday is this thing that I call the 5 C's of underwriting. Everybody's going to have their different version of it. This is my little proprietary blend. But generally speaking, we all conform to some version of underwriting standards that fit within the 5 C's. The 5 C's, and I'll just tell you what they are real quick, because then I'll tell you kind of the composition. Collateral is a very important, if not the most important C. I'm a new construction lender on single family and multifamily homes. I see a land deal, my lips get, I get real excited, but I can't do it. So as a collateral being one of the C's, I need to stay in my lane. So I'm not going to give somebody the best rate if it's the collateral that I don't do.
Sure.
Right? So that's one way, give the lender what they want. The second C, and this, I'm just going to throw them in order and then I'll put them back and I'll piece them back together. Second one is going to be credentials. Have you done this before? We're sitting in a beautiful hotel lobby here today. Somebody comes to me and wants to build a hotel and has been flipping or wholesaling houses for the last 10 years of their life. They're not credentialed to do this deal. They're not going to get the best rate. Probably not going to get the loan either, but that's a different story.
Sure.
But they built 2 or 3 of these hotels. Now we're talking. Cash. Cash is a huge part of the 5 C's. Cash is not only cash down payment, but balance sheet, the ability to carry a deal. Collateral, credentials, cash, credit. If you don't pay your bills, you're probably not going to pay us on time. Very important. The higher the credit, the more likely that you're going to pay, so the more likely we are to give you the best terms. And then finally, character, and I'm not going to spend too much time on character. Character is very binary. You're either good guy or bad guy. If you've stolen from somebody, we're not lending to you. And if you really, really, really need it, we're going to give it to you at the highest terms. If you've been good all your life, never been caught doing anything, we're going to give you a loan and we're going to give you the best terms. So there's an order to the 5 C's. So it depends on the lender's appetite. What is the most important thing? And I think that's something people need to ask the lender. What's the most important thing to you? So for me, it starts with collateral. Once you get over the collateral conversation, you tell me you're building a house, you're my best friend. You told me you're building a skyscraper, I'm retreating a little bit. But you tell me you're building a house, all of a sudden you've got the best terms, kind of starting terms. Next thing is credentials in this marketplace. We are in an appreciating market, and we've been in a bull market for a long time. So as the dust starts to settle, whether it be a year, 2 years, or 5 years, we believe, kind of as an underwriting philosophy, the people that are going to last, that are going to make it through it, the people that have done it before, right? Some people are able to do it because they're just, strong operators, good balance sheet. Generally speaking, if you've lived through the fire once, you could live through it again. If you've never done it, you're probably going to have an issue there. So if you strengthen those credentials, you're generally speaking, in today's marketplace of private lending, specifically private lending, you're going to get the best rate. Back to that client that I mentioned that's building the 290 unit in San Antonio. Wish I could say more about that deal, but at a high level, you've got a developer who's figured out the land, figured out the cost, figured out the construction, the whole thing. They're going to figure out a way to do the deal, and then you've got an investor, the guy that's bringing in the $6 million. These developers on their own were not able to get a loan from us. We might have done the loan for them. Actually, let me back up for a second. We said, sure, we'll give you a loan, but you need to bring $6 million. So what? And here's your terms. Let's just say I told them 10%. They bring in an equity partner, a guy with $300 million under his belt. Now all of a sudden, this guy's getting a 290 door multifamily build from a hard money lender at 7.99%. That's a lot to say. A hard money lender is lending on 290 doors at 7.9% to go vertical. So how you do it is give the lender the collateral they want, show them credentials that you've got staying power, and put up the right amount of cash, and that generally covers it all. Can't overestimate the credentials right now, because right now I'm betting on the jockey.
Yeah, and at some point that is one of the most important pieces, right? You have to bet on the jockey. How do I get the credentials if I don't have any?
Yeah, it's totally a partnership play. So back to this example, 2 developers, very experienced, built thousands and thousands of units throughout Texas, let's just say. Very experienced. So credentialed, through the roof. They don't have the cash. So what do? They need to partner with somebody. So that deal, again, kind of keeping it a little bit generic, they have a 50-50 partnership on the back end on the equity side. So developer takes 50% of the deal, and equity partner takes 50% of the deal. So you have to give a little to get a little. In this case, get a little is get debt.
Fair enough.
Yeah, it's awesome. And I think one of the big pieces to that, and I would encourage our viewership, is to understand that it does take time to do this too, right? Like, I think a lot of people in our space want to jump from lender to lender to lender and go, hey, will you give me a better rate? Will you give me a better rate? And it just doesn't work like that. They think it does, but it doesn't. What happens is if in order to hit all your 5 C's, it takes some time with the lender, right? It's a relationship. It's not, you're not going to JP Morgan Chase and just saying, here are my docs, right? Like,
Yeah,
this is a
we're friends for
relation-
30 years now.
Yeah, this is a relationship, and that is how you start underwriting on those 5 C's, right? So really, really important to build a relationship with the lender and the capital source.
Yeah.
Man, I'll add a little bit more to that, and it's so true. The last 6 months have been kind of a testing period for us. It's been good and bad. We had to kind of reach deep into like parts of the business that we haven't reached into over the last 6 months. We talk about it a lot, so you know exactly what I'm talking about. And what's kept things going and kept the ship moving in the right direction is those relationships. 90% of the business that we've closed in the last 6 months have been repeat clients. It's not a number that I say proudly from as a marketer. As a marketer, my heart is broken. But man, as a business operator, it's kind of what we strive to do.
Sure.
And it's because we did all that vetting years and years and years ago. And it's so hard. I know it's so hard for these clients, these borrowers, these investors to start that process again with somebody. They can, but to start that process again with somebody is so painful that they're not staying with me because of the pain. They're staying with me because of the simplicity.
Yeah.
Does that make sense?
Absolutely.
Yeah.
If you don't mind, for the viewer, we have given your name. We have not even talked about your company, where to find you, where to follow you, which I think makes the best podcast, right? Because we're really talking about the content you provide versus just the company that you keep, right? So if you don't mind, share with them, and I'll turn it over to you to wrap us up.
You got it?
Sweet. Okay, so my name is Romney Navarro, as the guys mentioned. Company that I run is called Streamline Funding. We are a boutique hard money shop out of Austin, Texas. We help builders grow at the end of the day. That is what we do. We don't focus on things outside of new construction lending on single family and multifamily. Our focus is those things. We do help people get from point A to point B, meaning if they're buying land to build some property on, we finance those types of things. But generally speaking, we are a builder's best friend. Streamline Funding is an Austin-based boutique hard money firm founded in 2002. This is our 20th year.
Well, congrats.
Yep. That's 20 years of gray.
Still looks good though.
Thank you, sir. But no, we've been doing it for a little while. We've made every single mistake you could think of. As a result, we kind of know how to do this thing that we do well. Personally, I could be reached by phone, by email, by whatever. Not to give all the credentials, but maybe the best place to just kind of stay engaged is through the socials. Romney Navarro on Instagram, LinkedIn, Facebook, or just RNavarro at streamlinefunding.com. I'd love to hear from you guys. The best way to make a connection sometimes is like we've never met. Sometimes those turn into 10, 15-year relationships. So see where that goes.
It's interesting how that one key word has resounded in this entire podcast, which is relationship.
Yeah.
That's the biggest thing.
Yeah, I mean that exists here, exists out there, and as I mentioned, I think the best client partners, if you will, are relationship based.
I think we leave it at that.
Yeah.
That's the show, guys. If you have any questions, get in touch. Go to thinkrealty.com/podcast. And of course, we could not have done this podcast without the help of our sponsor, Housefolios. If you want to check them out, go to housefolios.com. They can help you with sourcing, analysis, transaction management, rehab budget tracking, asset management, disposition in an all-in-one software for single-family real estate. You can grow and manage your whole single-family investment portfolio from one simple-to-use software. Again, check them out, www.housefolios.com. We'll see you later.